40 Turkish-owned businesses with a combined market value of $4 billion have been acquired by foreign businesses in the first 4 months of 2015, figures reveal, indicating a major retreat from an earlier Turkish bid to acquire troubled rivals in the region. The Turkish daily Bugün reported on Monday that the trend of Turkish firms selling subsidiaries as US dollar-denominated debt has surged amidst a decline in the value of the Turkish lira. The lira's record decline against the dollar 16% in April alone saw private sector debt jump to $202 billion, ushering in a wave of foreign investors who sought to acquire or merge with some strategically important Turkish companies, Bugün reported. The current trend marks a critical U-turn in Turkish investor tendencies. Pursuing opportunities to reverse Europe's debt crisis in the aftermath of the 2008 global financial crisis, most Turkish companies stepped up efforts to seek out and acquire troubled rivals across the continent. Some preferred to buy out or partner with these European companies, rather than enter European markets with their own brands, as part of a strategy to maintain the same European customer base. Recently, however, the hunter has become the game. In 2011, some economists believed that in the next 5 years Turkish firms would most likely take part in serious acquisitions abroad. They argued that the Eurozone debt crisis affecting some countries in the EU could cause firms in those countries to be sold at cheaper prices, opening doors for Turkish firms that were planning to expand and invest abroad. Some leading Turkish firms, such as food giant YLDZ, made some key acquisitions in Europe, but the goal of Turkish businesses acquiring cash-strapped firms in surrounding countries and Europe was never fully realized. Firms in key sectors being sold. Foreign investors have acquired 40 Turkish companies at a total value of $4 billion since the beginning of 2015, according to Ernst & Young Turkey's corporate finance president Musfik Kant-Kindler. Experts view these developments as an indication that domestic firms are trying to reduce exposure to Turkey's economic woes as much as possible. The fact that domestic firms have to sell off units and shares to cover debt is tragic, Bugün quoted FETA University International Trade Department President Dr. Osman Nuri Aras as saying. Aras added, "This is the only route out of the country, and the only way for companies to pay off their debts." The past few weeks alone have seen a dramatic number of foreign acquisitions of key Turkish firms. YLDZ Holdings sold its dairy unit, Akegda, to the French giant Lactalis, while the Qatar Mehula Fund acquired 30.7% of the Turkish clothing firm Boyner Perak and Yatrim. The Saudi company Sedco acquired a 19.5% stake in the high school chain Mektebim Kolji, with a goal to increase its stake to 50% in the next year and a half. Meanwhile, 65% of Turkish glassmaker Merv Optik was taken over by the French company Essilor in April. In 2014, Japanese company Panasonic acquired 90% of the electrical switch maker Vico. The private equity giant Abraj Group bought 80% of the Turkish dairy firm Ursun. The Japanese company Agitamo bought 50% of the sauce maker Kukurugda, and the Ferrero bought hazelnut producer Oltengda. We predict that toward the last quarter of 2015 there will be more mergers and acquisitions as the political uncertainty clears, said the chairman of the investment service firm Unlu & Co, adding that investors from the Far East also have their eyes on Turkish companies.